Good day, everyone, and welcome. It's a pleasure to have you join us for this webinar titled Indicators Unveiled, Tools for Trend and Momentum Analysis. My name is Ali, your host for today's insightful journey into the realm of technical analysis brought to you by Errante broker. We're excited to dive into the intricacies of how these critical tools can enhance your trading proficiency. However, before we begin, I want to ensure that everyone is having the best experience possible. So could you please confirm if my voice is clear and the video is streaming smoothly on your end? Please just type a quick yes in the chat or signal any issues you might be facing. Once you're all set, we'll move forward into the heart of today's topic. Thank you for your participation, and I'm looking forward to an engaging session with you all. Very well. Okay, I've got some confirmation. It seems everything is clear on your end. Perfect. Very well. Okay, let's get a start. Okay, guys, as we proceed with today's webinar, I want to remind everyone that the insights and the strategies discussed are for educational purposes only. So none of the contents provided should be taken as investment advice or as trading signals, please. We are here to learn and explore the financial markets together. Please make sure to do your own research before any trading or investment decision. Because the CFDs are a very risky product, so you need to consider seriously your capital, your ability to lose money, and also you need to make your trading decision based on your experience and financial knowledge. Okay, by the conclusion of our webinar today, we will have accomplished a robust understanding of key technical indicators and how to leverage them to your advantage. We will start with the basics of indicators, ensuring you grasp the essential concepts and the types available to traders. Next, we will master the three momentum indicators. First, ADX, delving into the average directional index to understand its components and signals, enhancing your market trend analysis. Following that, we will decode the RSI, one of the most popular momentum indicators we know, diving deep into the relative strength index to not just understand overbought or oversold levels, but also to spot divergences that can lead to actionable trading signals. We will review a very advanced trading strategy as well. And then we will also optimize with the stochastic oscillator if we have enough time exploring its calculation and adjustments to make the most out of its insights in various market scenarios. Finally, we will wrap up with an interactive Q&A session. So this is your chance to clarify doubts and discuss how to apply these indicators practically in your trading strategy for real-world scenarios. Okay, great. If you have any question, just write it down to me and I would answer it ASAP, or maybe at the end of the webinar if it's not related with the topic that we are discussing at the moment. Okay, so stay engaged, guys. Ask questions and let's make this learning really actionable together. So, as you know, we are going to talk about a very important topic in forex trading, indicators. Let's see, what is indicator? Indicators are special tools we used to look at and make predictions about the forex market. Indicators, let's say, they are, as a definition, they are mathematical calculations or quantitative tools. And we use them to past market data like price and how much was traded as volume or price tick to help us guess where the market might go next. So when we talk about indicators, we mean varied groups of statistical tools that each of these gives us unique information about the market. The purpose of using indicators is really helpful. They do a lot more than just look at past data. This is only one of the benefits that's or the usage that they can bring to us. They can help us understand the price action, which means we can get a better feel for what's happening in the market right now and what might happen next. They also help us see the likely future scenarios based on what has happened before. So this helps us decide when to buy or sell, or when to exit our open positions. Let's look at the importance of knowing indicators. Uh, the importance of indicators is huge, obviously. First, they make our market analysis better and more accurate. They give us a clear way to look at the market data, which can be very complicated. And this helps us be more confident in our trading decisions. They also help us lower our trading risk by understanding potential market changes. We can protect ourselves better. Indicators make it more likely for us to have successful trades by showing us market trends and possible turning points. So they are important for both people who trade over short period and those who trade over long periods, making them valuable for all traders. That's why they are a very popular tools in technical analysis and also trading forex. Now let's talk about why we have different types of indicators in forex trading and what makes each category unique. In forex trading, we use various indicators because each trader has their own strategy and the market can change a lot. Think of it like having different tools in a toolbox. Depending on the task, you choose the right tool. Firstly, we have trend indicators. These indicators are like a compass. They show us where the market is heading, whether it's going up, down, or sideways. Common examples include moving averages that we discussed in our previous webinar, and also MACD, which is developed based on moving averages. And they help us see the general direction of the market. And the essence of trend indicators lies in their ability to smooth out price fluctuations or volatility to provide a clearer picture of the underlying trend. Next, there are momentum indicators, and these are like speedometers for the market, measuring how fast prices are changing. If you see a car speeding up, it's similar to a currency price moving quickly. RSI and the stochastic oscillator are popular momentum indicators. That's why we are trying to cover all the let's say, the broad picture about both of them in today's webinar. Then we have volume indicators. These indicators look at how much is being traded or how many tick prices are delivered from the server in a determined period of time based on the fact that if you are trading stocks or trading forex products. In trading, more activity can mean strong support for the current price movement. Examples include volume oscillator and let's say the checking money flow. Lastly, we talk about volatility indicators. These are like weather gauges for the market. They tell us if there is a storm coming, meaning big price changes, or if things are cold. Bollinger Bands and ATR, or average true range, are key tools here. The main differences between these categories come down to what they tell us. Trend and momentum indicators focus on direction and speed, respectively, while volume and volatility indicators give us insights into market activity and price stability or instability. So why is this important, guys? Because understanding these differences helps us analyze the market more accurately and develop strategies that fit our trading style and goals. Then we will become better decision makers on when to enter or exit trades, which helps us manage risk better. So by using a mix of these indicators, we can get a fuller picture of the markets, making our trading decisions more informed and hopefully more successful. As we move forward, we'll explore how to apply these indicators in real trading scenarios, giving you practical skills to match this knowledge. Okay, as we progress, it's empowerment to understand another classification criterion, predictability value. This concept is pivotal in distinguishing how indicators can guide us in making preemptive or reactive trading decisions. Let's say indicators can be powerful in forecasting where the forex market will go next. However, it's crucial to understand that not every indicator has the same ability to predict future movements. This brings us to let's say, distinction between two types of indicators, leading and lagging indicators. Let's start with leading indicators. They are like the weather forecast for the market. They try to tell us what will happen before it actually does. This can be really useful because it gives us a chance to make our moves early. However, just like weather forecast, that can sometimes get it wrong. Leading indicators can give false signals as well because they usually come very early. So examples of leading indicators include the relative strength index, RSI, and the stochastic oscillator. On the other hand, we have lagging indicators, which are more likely story lesson. They confirm what has already started happening in the market and think of them as telling us, yes, the trend has begun, but only after the fact. So it means they are usually used to generate a late signals. They're more reliable in the sense that they give fewer false signals, but they are mean we might enter a bit later into a trend. As an example, we can mention moving averages and the MACD, which are trend following indicators, and for that, we consider them as lagging indicators. But why is it important to know the difference between these categories of indicators? If you have anything in mind, just write it down to me. Yep. Perfect. Yes. Using both types of indicators together can give us a more balanced view. Leading indicators can alert us to potential opportunities early on, while lagging indicators can confirm those opportunities are worth pursuing or not. And this way, we can tailor our trading strategy to fit our risk tolerance and goals, making decisions based on a mix of early predictions and solid confirmations. So as we move forward, think of leading and lagging indicators as two sides of the same coin, both valuable in their own right. But by understanding and applying both, we can develop a more nuanced and effective approach to trading in the forex market. But let's say there is another way to classify indicators based on their nature and visualization. As you might have heard, we have indicators and oscillators. Let's see what's the difference between these two groups. Indicators are our first group. Think of them as the tools that help us read the market story. Uh, they use data like price, how much is traded, and time, okay, to give us insights about the market price and price movements. So their main job is to highlight trends, measure how fast prices are moving, show changes in trading volume, and indicate how much prices are fluctuating. They have more direct relation with price. So when we look at charts, indicators can be seen right there with the price showing lines that move up and down with it, or they might be in separate graphs to make certain patterns easier to see. On the other side, we have oscillators. Oscillators are a specific type of indicators. So it's a smaller group of indicators that fluctuates above and below a center line or between set levels, showing us when the market might be pushing too far in one direction, either too high, that we call it overbought, or too low, we call it oversold. So this is like telling us when the market is stretching too much and might snap back. Oscillators are usually shown in charts below the main price chart. It'll be helping us see how the current price fits within a certain range or limits. You might see that, for example, when you apply a RSI or MACD or ATR, you see that's a new window just below the price chart. So why do we group these tools? One may ask, and let's say by understanding the differences between indicators and oscillators, you can pick the right tool for our current needs. This is like choosing between a hammer and let's say, a screwdriver, depending on the job. Some days we need to follow the trend. Other days we need to predict when the trend might reverse. Or let's say in practice, we use indicators to figure out whether the market is heading and oscillators to guess when it might turn around. By using both, we get a full picture of the markets, helping us, let's say, make smarter decisions about when to buy or sell, or when to enter or exit a position. And this not only helps us catch good opportunities, but also protects us from making moves that might lead to losses. In that case, we will be able to, let's say, come along with the trend following indicators, but not enter a trade very late by using the oscillators. So as we proceed, remember that the power of trading lies in using both indicators and oscillators, and they complement each other, providing a balanced approach to analyzing the forex market and enhancing our, let's say, trading strategy. Now, let's take one step forward and get through the more actionable part, diving into three important momentum oscillators. The first one we discussed today is the average directional index, or ADX. It's a powerful tool in our forex trading arsenal, guys. The ADX helps us understand if a trend is strong or weak by let's say by moving lines between above, let's say, or below a certain levels. However, we have to bear in mind that ADX doesn't tell us anything about the direction of the trend. So it's calculated from the plus DI and minus DI components, which measure the strength of upward and downward movements respectively. The ADX line then averages the difference between these two, giving us a value that represents the trend strength. So on the MT4, you can just go through insert list in the main menu, or just find ADX under trend indicators in your navigator window. Then as you double click this window, this window like this, like here, uh, pops on your chart, and you can set the features here. Uh, you can determine the period, which is 14 by default, and apply it on chart. So you, as you see here, it's an oscillator, appears below the price chart like this, and it moves along the price on the time axis just only. Yeah, and when the ADX value, excuse me, yep, when the ADX value is above 25, it suggests a strong trend is present, making it a potentially good time for trend following strategies. On the other hand, a value below 20 often indicates a weak trend or a range bound market where trend following strategies might not perform very well. However, the ADX, guys, comes with its limitations as well. It doesn't show the trend's direction, requiring us to look at another indicators or chart patterns for that information. Additionally, because it's based on moving averages, the ADX can lag. So it might provide signals a bit after the trend has started or changed. So in that case, you can use this momentum oscillator as a confirmation tool. So this lag can lead to missed opportunities in fast moving markets. But let's get through the, let's say, more details about ADX. Move on to how we can use the ADX for trading decisions. And let's uh, break down the bullish and bearish signals it gives us from strong to weak. In a bull market, let's start with the bull market. A strong bullish signal is when the plus DI crosses above the minus DI and the ADX is rising above 25. If you see these two conditions, uh, it indicates a strong upward trend. Also, we can generate a mild signal using ADX, which is seen when the ADX is rising towards 25 or hovering around 25. It's plus DI already above minus DI, suggesting that the trend is gaining strength, but not that profoundly. And also, there are some times that we see weak signals generated by ADX, and that's when the ADX is below 20 or falling towards 20 from a high peak, indicating a lack of trend strength or losing momentum in the prior trend. Even if the plus DI is above the minus DI, we don't consider it as a very reliable signal. Conversely, we can generate these similar signals in for bearish markets in the opposite way. In bear market, the strong bearish signal happens when the minus DI crosses above the plus DI, with the ADX rising above 25, showing a strong downward trend. As a mild signal, it occurs on the chart when the ADX is increasing between 20 and 25, with minus DI above plus DI, hinting at a growing bearish trend. And also a weak signal is when the ADX is below 20, suggesting minimal trend strength, even if the minus DI is above the plus DI. Also bear in mind that sometimes ADX can go too far to 45 or even 70. That said, if you see the DI's crossover when ADX is too high or when it's falling from its peak, we consider those crossovers a weak signals. It's crucial to remember the ADX's limitations. First, its sensitivity can lead to false signals. necessitating confirmation from additional indicators or chart analysis. Also, because it lags, the ADX might not capture very fast changes in the market. So understanding how to interpret these signals and the ADX's limitations can greatly enhance our trading strategy, allowing us to make more informed decisions about when to enter or exit trades. And the tip here is that it would be very useful that we use the different, we use the, let's say, the ideal conditions for generating a very strong bullish or bearish signal using ADX to somehow to level different signal with a different reliability as a strong, mild, and weak signal. But don't worry, I'm going to illustrate it here in an example. Let's see how we can effectively combine the average directional index with price action analysis to spot potential trend reversals and also understand the different stages of trends. Firstly, let's focus on understanding price action. We went through it in our previous webinars, but just let's have a very, let's say, brief overview of that. Price action is all about observing how prices move over time, creating patterns or trends. And these movements give us clues about what traders are thinking and where the market might head next. Recognizing pattern like head and shoulders, double tops or double bottoms, and trend lines are fundamental to interpreting price action, as we know. Now, let's discuss how ADX, let's say, behaves during different trend stages. At the beginning of a trend, look for the ADX to rise from below 20 to above 25. This indicates that the market is moving out of a range-bound condition and into a strong trend. So this is a way, guys, to calibrate our ADX indicator with the market trend, okay? During the continuation of the trend, an ADX that remains stable or continues to rise above 25 confirms that the trend is a strength and is likely to persist that way. The last stage is the ending of a trend. At the ending of a trend, the ADX that starts to decline from high levels suggests the trend's momentum is fading, potentially signaling a reversal. Now, let's combine ADX with price action to spot reversals involves several key signals. First of all, look for divergence between price action and the ADX. For instance, if prices are making new highs or lows, but the ADX is declining, it could indicate that trends strength is waning, suggesting a possible reversal. Pay attention to plus DI and minus DI crossovers that occurs usually alongside significant price action patterns such as head and shoulders or double top or double bottom. That can bring us to the signal 2. This combination can provide a strong signal of the pending trend reversal. As you see on the chart, for example, we have those conditions occur in the chart. At the beginning of a trend, we can recognize the first signal and the also second signal somehow if we want to rely first on the ADX itself, or we want to look at the price action first and then use the ADX as a confirmation. You see, after falling down toward the 25, we can see here that the plus DI crosses over the minus DI, and then we see from the price action that the price actually breaks above the last top as a significant resistance level, and then by observing these a top higher than the previous, the bottom higher than the previous, and breaking this resistance level, you can see the market is making new highs uh, above the previous top. So it's the definition of the beginning of an uptrend. So in that case, we see the ADX generates a signal 2 type for us using the price action pattern. And also here, the beginning signal when, as we mentioned, we see the ADX line is somehow starts its move above 25, but we see no confirmation from the price action. So it's a very, very early signal, but we can understand the divergence between price action and ADX that brings us to the signal 1. In that case, we put this stock or this let's say currency, which here is the USD JPY, on our watch list to see if we can get a further confirmation from the price action itself to maybe enter a trade. So, and then we have also the signal number 3 when ADX falling below 20 after a high reading, indicating a loss of trend's momentum, which can confirm for us the ending of the trend, like what we see here, ending a stage that produces a signal 3 when you see the ADX is falling down from this peak to below 25, and afterward we see the no, let's say, momentum or upward momentum in the price, while it's still above the moving averages and it's still trying to make new highs, but we see the price going to somehow like the coma here or a pause in the trend. So we can use all of these information to generate signals in both ways, as you see, for example, here to enter a new uptrend, or here at the beginning stages of a new downtrend in the market. By understanding how to interpret these signals and combining ADX with price action, we can enhance our ability to spot trends reversals and make more informed trading decisions. However, it's crucial to be aware of the limitations. Both ADX and price action analysis can lag, meaning they might not reflect changes in the market immediately. So there's also a risk of false signals, especially in volatile or choppy markets. So divergence and crossovers should be confirmed with additional indicators. That's the reason that you see we use usually the moving averages on our chart to get a further confirmation, or you can also use another momentum indicator here to see if we are at the level of overbought or oversold condition in the market as the price hits a new, let's say, the high resistance level or key resistance level or key support levels. I hope it was clear to everyone. So next, let's explore the relative strength index, or RSI, a key tool for assessing the momentum of price movements in forex trading. The RSI helps us let's say, identify potential points where the market might reverse its direction. Let's begin with the basics. The RSI is a momentum oscillator, and what does that mean? It's a tool that measures the speed and direction of a price movement, akin to how a speedometer measures the speed of a car. The faster the car, or in our case, the stronger the price movement, the higher the reading on the RSI. Now, onto the formula. RSI is calculated using this equation as you see here. It's 100 minus the parent is 100 divided by 1 plus RS. Here, as RS stands for relative strength, and It is the ratio of the average gain of periods when the currency pair closed up to the average loss of the down period. So let's break it down. Imagine you're looking at the 14-day period, which is a standard for RSI. And if on most of those days, the price is higher than it began, your RS value will be high, pushing your RSI closer to 100, which is the uh, upside extreme. Conversely, if prices often closed lower, your RS would be low, and so would your RSI, nearer to zero. Okay, so the RSI gives us a scale from 0 to 100 based on this formula to work with. And there are three key levels you need to know. Let's say 30, 50, and 70. When the RSI falls below 30, it signals that the currency pair may be oversold. Think of it as a product on sale. It's been sold so much that there may not be many sellers left. So this condition can suggest that a reversal might be near as the selling pressure eases off. The other threshold is 50, but I prefer to, let's say, break it down to not a just level, but a zone between 45 and 55, which is what we consider the neutral zone. This is where the RSI isn't telling us much. The currency pair is moving without a clear trend and is essentially in a state of equilibrium with no significant momentum to the upside or downside. Then we have some readings above 70. The RSI indicates that a currency pair might be overbought. Like a crowded room, there are more buyers than the market can handle, which might lead to a downturn as buyers start to leave or, in market terms, take their profits. Now, no indicator is perfect. Please pay attention to this. And the RSI is no exception. Here are three limitations to keep in mind. First, the RSI can remain at extreme levels during strong trends. So if there is a powerful upward trend, the RSI may stay above 70 for an extended period, misleading you to think a reversal is imminent when it's not. Second, it's not uncommon for RSI to generate false signals. A quick dip below 30 or spike above 70 might just be a blip in a larger trend, not a signal for a reversal. And third, the RSI shouldn't be used in isolation, like the other indicators. It's a tool in your toolkit, but it needs to be used alongside other analysis methods and indicators. Confirm what RSI tells you with other evidence before making a trade decision. Okay, so remember, successful trading is not about predicting the future. It's about managing risk and making informed decisions, because it might sound a bit uh, disappointing to many new traders that, oh my God, we're looking for a perfect indicator. We want something that can tell us the truth all the time. But unfortunately, such a thing uh, doesn't exist in financial world, because financial markets are based on the participant psychology, and the psychology can change, can be unexpected, and can bring some, let's say, unexpected result to us. And the RSI is a valuable guide in this journey, offering insights into the market's momentum and potential turning points. However, you need to use it wisely in conjunction with other tools to enhance your trading strategy. Let's dive into how we can use the RSI for making trading decisions, focusing on entry and exit signals in both bullish and bearish markets in a way that the RSI can generate for us. By understanding the signals, you can make more informed decisions about when to enter or exit trades. Let's look at bullish signals first. In a bullish market where prices are generally rising, the RSI can provide us with three types of signals. My favorite way to categorize signals, or let's say to rank them from strong, mild to weak. A strong bullish signal, let's see what it is. As you see here, it occurs when the RSI moves above 30 from an oversold condition. It says if the market is taking a deep breath and preparing to climb. This is often considered a strong buy signal, suggesting that the market's downturn is losing steam and an upward reversal is likely. The major setback to this type of signal is that it happens rarely because during a strong uptrend, we don't usually see the RSI falls below 30 or even get close to the oversold area in the selling zone. It usually ends up somewhere near the neutral zone when we see a very strong uptrend is losing momentum. But if it happens, it can be a very, very strong, let's say, signal that tells us the market eventually gonna turn back to its prior trend, which is a bullish trend. So that would be a buy opportunity. The next one is a mild signal. When the RSI crosses above 55, it indicates growing bullish momentum. And this isn't an emphatic as a strong signal, but suggests that the market is gaining strength. Traders might see this as a confirmation to hold on to existing long positions or to consider new long entries. I think most of you might be, let's say, familiar with these types of signal. A weak bullish signal, an RSI reading in the 55 to 70 range without additional confirmation may be seen as a weak bullish signal. Here, the market is showing some positive signs, but without other supportive indicators, the signal alone might not be a reliable prompt to buy. And also we have these three types for bearish signal. Let's start with this strong one. In the opposite side, this is indicated by the RSI falling below 70 from an overbought condition. And think of this as a sign that the market could be running out of steam and that a downward move could be on the horizon. But again, it rarely happens during a very strong bear markets. But when you see that during let's say the general downtrend, you see the RSI jump to 70, you should just fasten your belts for a market movement to the downside sharply, because during a very strong downtrends, it can be a very strong bearish signal. The mild bearish signal is when RSI crosses below 45, signifying increasing bearish momentum. It's not, let's say, as decisive as a strong signal, but it can be a nudge for traders to consider preparing for a potential downtrend or to exit long positions. And also the weak bearish signal occurs when RSI reading is something between 30-45 range without further confirmation is considered a weak bearish signal. And it's a nudge rather than shove, hinting at possible bearish activity but requiring more evidence before taking action. It's crucial to acknowledge that RSI signals have limitations too. RSI sensitivity to short-term price changes can sometimes result in overreactions, leading to false signals. It may not reflect long-term market trends accurately, and its effectiveness can vary depending on market conditions. Therefore, seeking confirmation from other indicators or analysis tools is key. So when you trade based on RSI signals, always look for additional confirmation before making a move. And this could be in the form of price patterns, uh, other technical indicators, or fundamental news that support the signal given by the RSI. And remember, in the forex trading, again, uh, uh, produce pace. Use this signal as part of a broader strategy and never rely on a signal indicator to make your trading decisions. I see that many new traders usually make this mistake that they think they should generate their trading signals using indicators. However, professional traders use indicators only as a confirmation tool, as an extra tool in their uh, toolbox. We must look at the price action first if you are a price action trader, and after getting a broader picture of the market and understand the reasons behind the price move, or let's say measure the strength behind the price movement, then you can rely on the indicator for further information to get more confidence to enter or exit your position. That's the let's say the correct way to generate trading signals, not using the RSI. Don't look at the price, see, okay, RSI is coming up from the 30 level, I'm gonna buy. It may, eventually make you huge losses. After exploring, let's say, the typical implications of RSI levels, we go through an advanced method of utilizing the RSI to gauge the ending stage of trend momentum, diving into the concept of divergences, including both bullish and bearish types and their implications, covering regular and hidden divergences. Let's say divergences offer us a sophisticated clues about the underlying momentum of the market and potential shifts in trend directions. They occur when there is a noticeable discrepancy between the price action and what uh, our indicators, such as the RSI, are indicating. This divergence between the indicator and price action can signal both reversals and continuations in the trend, providing valuable insights for our trading decisions. So let's delve deeper into bullish divergences. A regular bullish divergence signals that the downtrend might be running out of steam. This is seen when the price continues to form lower lows, which normally indicates bearish sentiment, but the RSI makes higher lows. This discrepancy suggests that despite the downward trend in prices, the bearish momentum is weakening, hinting at a potential reversal to the upside. Conversely, a hidden bullish divergence points towards the continuation of the current upward or upward movement or uptrend. It occurs when the price makes higher lows, a bullish sign, but the RSI shows lower lows. And this suggests that although there might be a temporary pullback in the uptrend, the overall bullish momentum remains strong, indicating that the uptrend is likely to resume. As you see in this underlying examples to illustrate the both regular bullish divergence and hidden bullish divergence, you see we have this discrepancy between the uh, direction of the lows of the oscillator and the price. And it means if we have the, let's say, ongoing downtrend, it means uh, it signals lack of momentum, enough momentum in the market, and a probability of reversal or turning market direction. Uh, on the other side, uh, if we see during an uptrend, we have the higher lows in the market, but the lower lows in the indicator, or formed by indicator, it means we are going to continue the price. Why? Because when the RSI, for example, falls below the previous low, it means the strength of sellers or the number of sellers in the market rose. But as a result of the increasing number of sellers, we see they have not been able to bring the price lower than the previous low. It means the lack of bearish momentum in the market, and it means the bulls gonna take advantage of this situation, and the trend probably will continue in its prior direction, which is upward here. Now, switching our focus to bearish divergences. A regular bearish divergence is a warning of a potential reversal from an uptrend to a downtrend. So it is observed when the price achieves higher highs, indicating a strong buying pressure in the market, but the RSI forms lower highs, pointing to weakening momentum behind the price increase. And also we have hidden bearish divergence on the other hand, signals that the current downtrend is expected to continue. And this pattern emerges when the price creates lower highs while the RSI plus higher highs, suggesting that the selling pressure remains dominant despite any temporary retracement. So it's very important to learn how to correctly use the definition of regular and hidden divergences in both bullish and bearish markets. Understanding these signals is key to identifying potential turning points or confirmations in the market trend. However, it's important to remember the divergences have their limitations as well. One of the challenges is the timing. A divergence can develop over an extended period of time, making it, let's say, hard to accurately predict when a trend reversal or continuation will happen. Therefore, it's vital to use divergences alongside other indicators and chart patterns to confirm the signal before executing a trading strategy. But we are going to explore one of the most reliable approaches to utilizing the RSI involves its combination with price action analysis. Having already explored the, let's say, intricacies of RSI levels and divergences, it's time to delve into another advanced technique here, the failure swing trading setup. Guys, please let me know how many of you are already familiar with failure swing trading setup with RSI. Please write it down to me through the chat box. Okay, so since it's new to many of you, very well. So please pay attention to this method. It can enhance our ability to identify potential market reversals with greater precision. Okay, so first, let's clarify what we mean by the price action. As we explained before, it refers to the study of price movements over time, which form distinct patterns reflecting the underlying market sentiment and trend direction, okay? And now we want to discuss the RSI failure swings. These are specific patterns observed within the RSI indicator that indicate a weakening of the prevailing trend, signaling a potential for trend reversal. If you remember, when we explored the, let's say, um, trend and trend reversal webinar, we had a webinar about that, and we explored the failure swing formation or chart pattern for price. Now we are going to apply that rules on RSI itself, and then we will find out how we can mix it with the price action on the price chart, and then we can generate a very, very reliable and precise entry signals. So let's say, what is a bullish failure swing? A bullish failure swing is characterized by the RSI making a low, as you see here, yep, rebounding, retracing without breaching the previous low, and then conquering its preceding high, suggesting an exhaustion of selling pressure and a possible upward trend reversal. Conversely, that's the definition of bullish failure swing. Forms a low, rises, pulls back slightly without reaching the previous low, then breaks its prior high or prior top. On the other side, we have a bearish failure swing. It occurs when the RSI reaches a peak, declines, makes a partial recovery without surpassing the previous peak, and then dips below its recent low. It indicates the, let's say, dissipation of buying momentum and a potential downward reversal. To effectively combine these techniques together, we need to follow a step-by-step approach. First, begin by identifying key reversal patterns through price action analysis. This initial step provides early hints of a changing market trend. As you see here, we can recognize the head and shoulders pattern, which is a very popular bullish reversal pattern. It's the reverse head and shoulders, obviously. This is the first step, okay? Identify potential reversal pattern with on a price chart. Next, align these observations with an RSI failure swing, as we already identified it on a chart here. And this correlation strengthens the reversal signal, suggesting a more robust case for an impending shift in trend direction. And finally, seek additional confirmation from other indicators. On the other side, you see we have, let's say, a double top pattern here, and this green line just indicates the neckline of the pattern, and we see it comes along with the RSI failure swing, as we have this almost matching top on the price chart, but we see the lower top with the RSI falling down from the over both areas, and then breaking below the latest RSI low or RSI bottom here, along with the price breaks below the neckline, closes below the neckline. And as a confirmation here, we have our moving average. As you see, during the formation of this reversed head and shoulders pattern, we have a very clear cross above the moving average, and also during this double top pattern here, after completion the pattern, we see another confirmation from the moving average by the price crossing below the moving average. So it can be also another indicators. We can utilize volume indicators to confirm momentum, or the MACD to affirm change in trend strength solidifies the reversal signal, enhancing its reliability. However, it's crucial to acknowledge the limitations inherent in this approach as well. Accurately timing market reversals can be challenging. Okay, so as not all failure swings or price action patterns immediately lead to a trend reversal. That's why we need to manage our risk very, very carefully and don't enter a trade above the, or let's say, with a risk, exceeded our potential tolerance level somehow. So moreover, interpreting these signals effectively demands experience, underscoring the importance of employing a multifaceted analysis strategy by incorporating various tools and indicators for verification. Okay, the last momentum oscillator that we will be able to cover in this webinar today is the stochastic. Now let's delve into the stochastic oscillator. This is the momentum oscillator aiming to gauge market momentum and potential reversal points for comparing the current price to its range over a given period of time. When you apply a stochastic on the chart, it appears like this. As you see, it consists of two lines hovering between 0 to 100. One is percent key and the other is percent D. Let's see what are the components of the stochastic. The percent key line forms the core of the stochastic oscillator, calculated over a default period of 5 days or 5 candles, and captures the immediate momentum of the market. And then, let's say, the percent D line, essentially a 3 candle moving average of percent K. It helps in identifying the prevailing trade direction. So we have a percent K, and then we have a moving average of percent K called percent D. Okay. The standard settings for the periods are percent K at 5 and percent D at 3. You may find it out on the chart when you double click on the stochastic oscillator in your navigator window. But there is another component here as a slowing. Let's see what is a slowing. A slowing factor of 3 is a factor to smooth the percent K line, thus reducing the impact of market noise on the oscillator's readings. The levels and their interpretations are pivotal in utilizing the stochastic oscillator effectively. Readings above 80 typically suggest that the security is overbought and could be primed for a downward reversal, while readings below 20 indicate oversold conditions, potentially leading to an upward reversal. The interaction between the percent K and percent D, particularly their crossovers, provide actionable signals for traders. Let's say an upward crossover under 20 can signal a buy opportunity in general, whereas a downward crossover above 80 may indicate a sell signal. And lastly, this is the implication of the levels. Lastly, let's discuss how to fine-tune the stochastic oscillator to match different market conditions, enhancing its effectiveness as a trading tool. First, let's say adjusting the calculation periods can significantly impact the oscillator sensitivity. For traders focusing on short-term movements or operating in volatile markets, shortening the period makes the oscillator more responsive, offering quicker signals. Conversely, for those interested in long-term trends and trading in less volatile conditions, lengthening the period can provide more reliable signals by reducing market noise. And then modifying the slowing factor is another way to tailor the oscillator. Lower slowing factor makes the stochastic oscillator more sensitive, and so it's will capture rapid market changes that might be crucial for day traders, or let's say in highly volatile conditions. It can be very helpful. However, increasing the slowing helps to smooth the oscillator's movements, making them more suitable for identifying sustained trends by filtering out short-term fluctuations and reducing the likelihood of false signals. In practice, traders should adjust these settings based on the current market environment and their trading strategy. Let me point it out that in fast-moving or volatile markets, a shorter period and reduced slowing can help capture quick opportunities. And in more stable or trending markets, extending the periods and increasing the slowing can aid in recognizing more significant, lasting trends, avoiding the noise of minor price movements. Now, let's refine our approach to using the stochastic oscillator for entry signals, focusing on aligning our actions with the current market trend and understanding its effectiveness in shorter time frames. The fundamental principle here is straightforward. Align your trades with the prevailing trend. That's it. In uptrend, look for bullish signals as they indicate potential continuations or reversals within the context of overall bullish momentum in the market. Conversely, in downtrend, bearish signals become more significant, indicating possible continuations or downturn within the prevailing bearish trends. Now let's take a look at the bullish signals that you can generate using a stochastic oscillator. For bullish markets, the strong signal is when the %K crosses above the %D line from below 20, highlighting a shift from oversold condition back into momentum, a prime opportunity for going long. Similarly, guys, please consider the fact that we can also generate different, we can also, let's say, rank the signals, okay, generated by stochastic as a strong signal, as a mild signal. As you see here, the strong one is when the %K over %D below 20, signaled by an uptrend, and the mild signal is when we see the %K crosses above %D between 20 and 50. I mean, above 20, but still in selling zone, continued bullish momentum. And this is considered as a mild signal. And as we mentioned, we always focus on oversold signals for long positions with the trend. Why? Because as you saw, the periods, the default periods for %K and %D is very short, it's at 5 and 3. So it means stochastic supposed to show a very fast fluctuations in the market. That's why we just jump on a buy position, buy entry when we have the oversold area. Okay. I hope I could answer your question. Okay. Okay, let's say similarly in bearish markets, a strong signal occurs when the %K line crosses below the %D line from above 80, indicating a shift from overbought conditions to potential downward momentum, as this is an ideal scenario for short selling. Also, we can generate a mild signal when we see the percent K crosses below percent D when both of them are between 50, 80 range. That's a bearish momentum continuation, more likely. So an important observation is the stochastic oscillator's suitability for shorter time frames. Let's say it thrives in these conditions, offering timely insights into price movements that can be crucial for short-term trading strategies. By focusing on these your quicker signals, trader can effectively capitalize on, let's say, the rapid changes that characterize financial markets. However, it's crucial to be mindful of the limitations. Signals that contradicts the prevailing trend can lead to misguided trades, underscoring the importance of trend alignment. Moreover, the inherent volatility in shorter time frames necessitates additional confirmation through other analysis tools to ensure the reliability of stochastic signals. By adhering to those principles, traders can enhance their strategic use of the stochastic oscillator, leveraging its strength to align with market trends and capitalize on short-term movements while navigating its limitations with a comprehensive, informed approach. So its effective best suits short time frames for rapid signals and is ideal for short-term traders to spot quick reversals and momentum shifts. Uh, let's say uh, it's essential to understand how professional technical analysts leverage this tool to gain deeper insights into market momentum and potential trend reversals. Divergence identification plays a key role in advanced stochastic analysis. A bullish divergence when the price makes lower lows, but the stochastic oscillator makes higher lows, often precedes the potential upward reversal. Conversely, we have a bearish divergence, signals a possibly downward turn, crucial for anticipating trend shifts before they're fully realized. Let's say professionals usually pay close attention to overbought and oversold conditions in the context of the prevailing trend. In a strong uptrend, for instance, the market might remain in the overbought territory for an extended period of time. And here, a directional crossover within this zone is viewed as a continuation signal rather than an immediate reversal indicator. Excuse me. And it's very important to consider when, so it's vital to, let's say, somehow identify the strength of the trend beforehand using the lagging indicator or those trend following indicators before you look at the situation condition of the stochastic in the market. Other way, we have the uh, multi-time frame analysis that can further enhance the utility of the stochastic oscillator. It allows an analyst to, let's say, sift through noise and pinpoint more reliable entry and exit points by confirming signals across different time frames. We're going to explore how to, let's say, amplify the effectiveness of the stochastic oscillator through multi-time frame analysis, a technique that can significantly enhance the precision of our trading decisions. The concept is simple yet powerful. So if you're not familiar, you have not heard about it, please pay attention. Instead of focusing on a single time frame, we, let's say, expand our horizon by analyzing the same currency pair across different time frames to identify consistent signals. Often, for example, spotting a bullish divergence on a M5 chart or the 5-minute charts you see here, where our stochastic oscillator begins to ascend while prices dip, we don't rush in. Instead, we transition to the 1-minute chart for a closer look. And here we are hunting for breakouts. The price must surge above a previously established resistance level. Concurrently, we need our moving averages to intersect, signaling a shift in momentum as well, as you see here. Now, eyes on the stochastic oscillator. A crossover between the %K and %D lines, particularly from an oversold condition, is our green light here. And this convergence of signals, the breakout, the moving averages, crossovers you see, and the stochastic crossover forms a robust case for entry for us. So again, what we are looking for is a break above a key resistance level first, a point where the price has struggled to climb above previously, and we also want to see a crossover of the moving averages, a sign that the short-term price momentum is shifting upward. Simultaneously, we examine the stochastic oscillator for crossover between the %K and %D lines within the 1-minute time frame. This crossover, particularly when it occurs out of the oversold territory below 20, adds weight to our evidence pile that a bullish reversal is in play. However, it's critical again. See, we have the divergence in oversold area here, and we have a directional crossover here on stochastic. But guys, please be informed. It's critical to acknowledge the limitations here as well. Stochastic signals, particularly in shorter time frames, may reflect market noise, so necessitating the need for additional confirmation through other technical indicators or analysis methods to refine trade strategies. As you see, we here in the multi-time frame analysis, we try to combine the different methods from a different charts horizon, and also we try to incorporate the moving averages, or maybe some traders prefer to use another oscillators as well to have a more, let's say, clear picture of the broader market here, to be more confident about entering a trade here. But in this case, you can understand the market first, and then you will be able to generate your own buy signal using the stochastics in different time frames. Okay, I would say we've gotten to the end of this webinar today. I would like to thank you all staying with me this long, and I hope you found this interesting and helpful in your trading journey. I hope you follow us on our website, through our social media channels, and I can't wait to see you next week, where we are gonna to explore more nuanced information and techniques in technical analysis to develop a much more, let's say, reliable strategies and risk management and trading plans together. Thank you so much. Hope to see you next week. Thanks. Have a great evening.